Let's say that several weeks ago on September 9th, we had entered a put option credit spread on Amazon. Let's say that we had sold the 3,300 put option and bought the 3,000 put option to protect us. So we had the same $300 per share at risk. And let's say that, for example, that we had received that same $9 per share. Let's also go with the same October 15th expiration day. That's now 22 days away, as you can see here. The problem is that Amazon is now only 2.8% away from being at the money on our short put option because it's trading for right around 3,400. Here's how I would go about adjusting this put credit spread on Amazon if it went against us like this one has. As you can see here, 4 days ago, this spread was actually at the money. Now, we don't want this thing to move against us in a big way and push us towards that $29,100 loss. So how can we adjust this position now to make sure that we're improving our odds of winning this position now that Amazon has dropped in price? Here you see that the $3,300 short put option is now trading for between $35.10 per share and $36.20 per share. So if we go in the middle, it's trading for $35.65 per share. The $3,000 put option that we bought to protect us is selling for right at $9.25 per share. So if we close this position out, it would cost us $26.40 per share. That would result in a net out-of-pocket loss of $17.40 per share if we didn't do anything about it. Let's see what we can do to adjust this position and prevent having to come out of pocket $17.40 per share, all while improving the odds of winning in this overall position. One thing we could do if we had the extra capital available would be to widen the distance between our two strike prices and roll them down. Now you see that we're looking at the November 19th option chain, which expires in 57 days. So that gives us an extra 35 days to win on this trade. Notice though that we're going from a spread of $300 per share wide to a spread of $470 per share wide. So instead of having $30,000 at risk, we have $47,000 at risk. You're probably beginning to see one of the big disadvantages of doing trades with credit spreads. When a position moves against you, it's very challenging to adjust it for a credit. But let's continue with this scenario. Let's say that we had the extra capital available to increase the amount of money that we had at risk. Notice that we would be able to sell the $3,020 put option for about $37.40, and it will cost us $9.80 per share to buy the $25.50 protected put. So the net that we'd put into our pocket would be $27.60 per share. If you back out the cost to close out the one that expires in 22 days, $26.40, that means that we would walk with $1.20 per share cash into our pocket for rolling this position down and out. This is not ideal, but it does allow us to put a little bit of cash into our pocket, and it gives us an additional 8.5% that Amazon can move against us, and we'll still get a 100% win with this position.